And the performance debate continues, and I've talked a little bit about that, so I think I can slide right by that. Despite higher costs, the fundamental indexes are outperforming for the reasons I cited. Is there a right approach? I have to get my glasses just in case I hit one of those slides again. In an active approach, is the active-passive debate actually is unsolved, what strategy should we use? Is there something that we can take away from this session here, because we're never really going to ever solve this debate? Can advisors manage the asset mix? Is that important to you? Is that something you want to do? If your practice is managing a relationship with a client, maybe you don't want to worry about the asset mix and the rebalancing of the portfolio and all of the issues that go with that. Now, I want you to understand just why I say, if you're using passive investments, it is important that you handle the asset mix. When you are using an index, you always know where the index is invested. So, let me take a combination. Let's take the TSX 60 and the iShares bond index, and for argument's sake, allow me to have 70% of this investment in the XIU, which is the TSX 60, and 30% of my money is tied into bonds. I now have a 70-30% mix. That combination probably looks a lot like a lot of mutual funds that are trading in Canadian equity today, because value funds typically have a bit of a bond component because they're having more trouble finding value stocks today. You might have the active manager with a 70-30 split, even though it's a Canadian equity fund. So the point is, you can create the same thing with indexes that the manager may be creating on their own inside a fund. That's why the asset mix decision rests with the advisor. May or may not want to do that. What indexes do you use? If this is something you do feel you want to do, what do you use? Well, do you use those broad-based market cap indexes? Do you use those fundamental value indexes that I just talked about? And what about sectors? You can now buy exposure to various sectors using things like exchange-traded funds, just like you currently do in the mutual fund area, using actively managed funds. ETFs are off-limit, as we said, to most non-IROC advisors. Is there an alternative solution? Well, one of the solutions that's been promoted out there, and this has come to light particularly in the last 3 or 4 years, but it's been talked about probably for the last 10. I remember talking about this strategy in, I guess, the mid-90s, 1999. Eric Kersner and I did some work for Charles Schwab when they were in Canada, and we actually, in Canada, built their Core Explore program that they marketed worldwide. Now, they don't do that anymore because they've gone back to becoming a discount broker, but it was interesting that that concept is now gaining more momentum as we start to go into the marketplace. And the idea really behind this is that investment management balances the science of managing risk and return, the art associated with experience and insight, and the reality of managing fear and greed. I love those lines. I would love to tell you I wrote those. That's iShares, actually. But what a great simplistic comment that ties everything together. Now, the problem is this. Nowhere is the balance more evident than in the process of designing an investment strategy, whether in the steps taken to design an appropriate asset mix or the considerations for tax efficiency and cost-effective rebalancing. A core satellite strategy that explicitly combines active and passive investing, in my opinion, not just my opinion, in the opinion of the industry today, is a very powerful tool that advisors employ to strike a balance for their clients. So maybe that's the answer. Maybe it is a mixture of some passive as a core piece, surrounded by some active managers, maybe some sector exploitation, and the seeking out of alpha strategies. Well, wait a minute now. What I've just told you is investment management 101 from the university level. In fact, if you go to the Canada Pension Plan site, that's exactly how they manage the Canada Pension Plan. So maybe if it works there, and maybe if pretty much every pension plan in Canada operates under the same models, maybe that's the right approach for all of us to take for our clients. This is one of the things that we felt it was important in our shop to build internally. And I'll tell you what's also important is you have to have that base to operate from, because without that, you'll never be able to keep up with all of the changes that are going on in the landscape today, and particularly in the investment field. For example, let me give you one. Do you know that today you can buy an exchange-traded fund based on volatility? Now think about that. In other words, based on how much the market goes up or down, you can actually buy an exchange-traded note, actually, issued by Barclays Bank that tracks volatility. Now, why is that important? It turns out that if you look at volatility, now this is something because I've dealt in the options world for 30 years, but if for most people this is becoming a very new concept. Volatility actually has a negative correlation to stocks. Now that's not surprising if you think about it. Volatility measures fear and greed. Stocks are rising, there's not too much fear, stocks crash, fear rises. In fact, from history, the negative correlation ranges from minus 0.35, and if there are math people in here, they're going to say, wow, to minus 0.77, going back to 5-year timelines. What's even more interesting is that volatility is 5 times more volatile than stocks. Now, what does that mean? Well, the exchange-traded note that Barclays launched came out in February when the market was going through all its gyrations, 2008, came out at $120 a share. Today, it's trading at $29.65. Now, volatility can never go to zero because the market's never going to go like that. Volatility can never go and spike to any great level for long periods of time because if the markets are too volatile, nobody will invest. So there's always a range. You have a product with negative correlation. The fact it's 5 times more volatile than equity means you don't need very much of it to hedge your equity position. And if you're diversifying a portfolio, what are we using today? You've heard it today in the presentations that you've heard today. A lot of people use gold because gold tends to have a lower, not negative, but a lower correlation with common stocks. So you want to have a little bit of gold as a hedge in your portfolio. Mark my words, in the next 3 to 5 years, gold will be displaced by